Every day, the ETF complex is buying roughly 3 times the number of Bitcoin that are mined. So I got the halving socks on today, and that's only for the next 3 months. 3 months from now, that number goes from 900 to 450. If the same pace keeps up, which I think is pretty likely, you're going to be talking 6 times the daily production. And so that is a supply-demand imbalance that will lead to rising prices.
Spot Bitcoin exchange-traded funds have been the primary focus of the cryptocurrency industry for 8 consecutive months. Initially, there was excitement surrounding BlackRock's application to offer a spot Bitcoin ETF. This anticipation was followed by months of speculation regarding its approval. Since the announcement of approval on January 10th, hopes for significant price movements have been tempered. Despite an initial surge to $49,000, Bitcoin's price has remained relatively stagnant. Analysts attribute this to investors rapidly withdrawing funds from the Grayscale Bitcoin Trust. Unfortunately, over $6 billion has exited GBTC in less than a month, but there is a silver lining. Some of this capital is flowing into other Bitcoin ETFs, and the GBTC sell-off appears to be slowing down. Recent reports indicate that Bitcoin ETFs received over $700 million in fresh investments last week, offsetting the decreasing outflows from GBTC. BlackRock's IBTC and Fidelity's FBTC have seen significant weekly inflows of $884 million and $674 million, respectively, surpassing their previous week's figures. Meanwhile, GBTC recorded a lower outflow of $927 million compared to the previous week's $2.2 billion. The new ETFs have amassed $7.7 billion in funds as of last week, outstripping the $6 billion outflows from GBTC. Hedge fund manager Mark Yusko predicts exciting times ahead for Bitcoin in 2024 and 2025. With GBTC outflows subsiding and other ETFs experiencing high demand, coupled with the impending 2024 halving event less than 2 months away, which will reduce the Bitcoin block reward, creating a supply shock further compounded by ETF demand.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The idea that all of the money, right? We've talked about all the different estimates from, 30 billion if, investors that the captive investor base in these brokerage firms that haven't been allowed to participate, is roughly 30 trillion, pick a number, and 0.1% would be 30 billion. And that would move the market. And we've seen about a third of that. We've seen a little over 10 kind of come this way, but it doesn't happen in day one. I would argue that 0.1 is even kind of a silly number. I think it's easily going to be 1%. So that's 300 billion. But what we saw was a bunch of the big guys said, oh, no. Even though this is a BlackRock or Fidelity approved ETF, we're still not going to let you buy it with your money. So people said, well, I'm out, right? I'll just leave and go someplace else. But eventually, I think they're going to change their minds, and that money will continue in. Rising prices beget rising prices, right? Once an asset starts to move, people are drawn to it. That's the way it works. And that will push us past fair value into, silly levels sometime in the crypto fall that'll start, next June. And a year from now, I think we'll be talking about, oh my gosh, how did we get to triple digit Bitcoin? And when's the bear market coming? Because there will be another bear market, because the FOMO gets really extreme as you start to go parabolic in any asset, like NVIDIA right now. I mean, Tesla before. NVIDIA right now it's amazing to watch. The volatility, it's from this side. Its volatility is trending down it's reversed on my screen. I can't do it. It's confusing my brain. But volatility Bitcoin was triple digits when it started because it was a science project. There was no there. It was super vol, a little penny to 2 pennies. That's 100% move. But as it has gotten more mature and gotten bigger, that volatility is now trended down. It's like in the 40s, long-term still closer to 65, 70, but we're definitely going to trend down. And it's because the passive holders, hodlers are part of that, but now the ETF is structurally a passive holder. Leverage is also down. So there's not as much leverage and as much speculation. There will be more leverage. Leverage will come back, but there's not as much as there was. So I don't disagree with that at all. But the passive versus active debate is a tough one, because the more passive there is, the more you just keep reducing the supply, and that's like a supply shock. And that 3% number is actually probably not right. Not that your number's not right, but I just saw this stat that kind of blew me away. I mean, I knew the lost or stolen component of Bitcoin was big, but I never saw it in a visual. The estimate is that 5 million of the 19 million coins that have been mined to date are untouchable. Lost, stolen, stuck in multi-sigs where somebody's passed, or that's a big number. And even if it's not right, it's probably not off orders of magnitude. And so that 3% is probably more like 5% and trending to a very large number. So supply shocks will lead to higher prices.
Like many other prominent Bitcoin investors, Yusko predicts that Bitcoin will surpass its all-time high of $69,000 before the year's end and reach six figures before the conclusion of the bull market in 2025. Leading up to the halving, Yusko anticipates Bitcoin gradually ascending towards $50,000 per coin, aligning with its current fair value according to various price models. He also forecasts that the anticipated crypto rally will commence 2 months post-halving, heralding a period of truly exponential growth between June 2024 and the latter half of 2025. In his projections, Yusko suggests that Bitcoin will achieve a minimum of $150,000 in the base case scenario and potentially soar to $300,000 if conditions exceed expectations. We invite you to share your thoughts on Yusko's forecast as we delve into more insights from the podcast, this time focusing on his perspective on the broader U.S. economy.
I mean, look, the idea that they were going to cut rates now it was always silly. And I guess the market, right? And what is the market? It's the collection of the participants. I think actually believe they could bully the Fed into it, which, because it's always that, well, this predictor is always right. Well, no, it's not causative, it's correlative. I think that was the first thing. So the idea that suddenly we were going to be in a world where rate cuts were not only necessary but were politically palatable, I think was silly. Now, we are in an election year, and as we get closer to the election, I think the odds go up dramatically that there'll be pressure from the incumbents to cut rates. So that I think is real. But again, if you look at history, when do Feds cut rates? They cut rates in response to economic weakness and recession. Like we're literally in recession. It hasn't been called yet, but if you look at the chart, you got the gray bars, and those are the recessions, and the rate cuts start inside those gray bars. But those gray bars haven't been called at the time of the rate cuts. That's kind of like the acknowledgement by the Fed that, things are getting bad. And then 9 months later, the powers that be, the NBER, say, yep, you were right, there's a recession. So not anywhere close if you look at the data, particularly, GDP data surging. Now, that's a false flag in that, Q4 GDP. But it's like, yeah, look how great we are. That is the best $300 billion of GDP that $800 billion of fiscal deficit could buy. If I pay $800 billion for something, I better get more than $800 billion. Don't give me $300 billion. Where the hell did the other $500 billion go? Interest and other places. So there is a bad multiplier effect in government spending right now. It's worse than the normal government spending. Government spending has a negative multiplier. What you want for economic growth is corporate borrowing and spending, not government. Government crowds out private. So that's bad. So that's the first thing. It's just a myth that, we just pumped up the economy with fake money. And anyway, so we got that. Then second thing is jobs. And, you know, you and I have talked about this ad nauseum, so I'm not going to belabor it, but, you know, they're going to keep faking the jobs numbers. And I sent you the analysis the other day that, you know, it's like 50% of the reported jobs then get taken off later in adjustments, but no one looks at the adjustments. So whatever. So they're going to keep lying about jobs. And so no chance that you could just say, we're going to cut. Now, does that really matter? Well, the market response was pretty quick. To me, the more important thing from the FOMC was the removal of the lines about how stable the banking system is. If you've been watching in the last couple of days, bank stocks are getting cremated, and the BTFP, Bank Term Finance Program, BTFP, ends March 11th, you know, right around the Ides of March, which is not really a good time normally, historically. I think, pick a number, 15%, 20% of banks are going to be bankrupt, like out of business. And what's going to happen?
With the bank term funding program scheduled to conclude in March as initially planned, concerns are mounting among experts regarding the near-term prospects of the regional banking sector in the United States. Projections range from a mild crisis, which could result in the closure of a few banks and prompt the Federal Reserve to implement additional funding initiatives, to a more severe scenario that could severely disrupt the banking industry and have adverse effects on other sectors. Furthermore, there are warnings of a potential commercial real estate crisis that could exacerbate the situation. Despite these concerns, Federal Reserve Chair Jerome Powell remains notably optimistic about rate cuts in 2024. According to Powell, the Federal Open Market Committee merely requires a few more positive economic indicators, not necessarily surpassing previous months' data, to justify rate reductions. Do you believe the Fed will indeed lower rates in 2024, especially if faced with another banking crisis? How might such actions impact the prices of Bitcoin and cryptocurrencies? Share your thoughts and insights in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.